Let me ask you this, Julian. When, if ever, has a global REIT fund or the total cash flow been able to grow by 6 to 7% a year?
Yeah, it's a good question. So it's been a number of years since we've clearly seen that level of growth. But pleasingly for us, just coming through reporting season now, we're starting to see evidence that's broadening to some of these sectors we touched on.
Welcome to another edition of Perspectives. My name is Rob Pizzichetta, founder of Mont Wealth, and today we are talking again with portfolio manager of Resolution Capital Global REITs, Julian Campbell-Wood. Welcome back, Julian.
Thanks, Rob. Great to be here again.
Obviously, the general advice disclaimer, Julian. Anything we discuss today is general advice only. Anyone acting on that advice without written and agreed consent does so entirely at their own risk. And obviously, the performance is past performance, and it's not an indicator of future performance. Obviously, you spoke at the Kooyong event back in March for the Mont Wealth investors. So thanks for your time then. But when we did speak 12 months ago on this podcast and YouTube, we spoke about the outlook for markets. Now, can you just make investors and listeners aware what the fund actually delivered over the last 12 months compared to the benchmark?
Yeah, so in terms of the absolute performance for the strategy over the last 12 months, it's been about 18%. And in terms of the alpha over that 12-month period, it's been a little over 3.5% net. So it's been a reasonable period for the fund and more broadly for the sector too.
To think about that though, 18%, most macro investors will think higher rates, geopolitical tension, working from home, data centers, all these things. How the hell have you delivered 18%?
Yeah, it reflects, I think, the starting point, which we've been highlighting for the sector, that it has been one which has been somewhat overlooked in recent years. It's been adjusting to those higher rates, which again, we've discussed that it has largely done that. And the fundamentals have been there, we think, for the last 12 to 18 months as supply is declining, replacement costs have been high, and tenant demand's been healthy. So the building blocks have been there. It's always hard to call when these things get realized by the market and what drives it. But we think the fundamentals continue to be pretty constructive for the sector.
All right, let's break down each of those headwinds, tailwinds for the global REIT sector. You spoke about replacement costs. Just give us a definition of what that actually means and where that is at the moment.
Sure. So when we talk about replacement costs, it really is the physical cost to build a new building. Bricks and mortar, labor, we typically exclude interest costs, but that is part of the broader replacement cost. Everything it costs you to build a new structure. And so when we look at the actual physical construction costs, they're up anywhere from 30 to 40% over the last 4 to 5 years. And on top of that, finance costs are clearly higher as well. So that overall construction cost to deliver a new building is substantially higher. And over that period, rents haven't kept pace. And actually, in many markets, building values have fallen 10 to 20%. So you've got this interesting period where it costs a lot more to deliver a building, but the returns haven't been there for a number of sectors to justify that new construction.
Okay, so there's so many bits we can go to from here. Let's start on the rental side. You'll see, so obviously replacement costs, rents are going up. What magnitude are rents rising across the board?
Yeah, really have to break it down by sector. This is true for the replacement cost dynamic because at certain ends of the real estate market, data centers, for example, clearly a lot of enthusiasm. There's significant rent growth across that market given the current compute shortage. And then at the other end of the spectrum, you've got some sectors which are coming out of that tail end of COVID supply. So you're just starting to see industrial logistics rent growth start to pick up in the US, for example. Yes, select office markets, that's something that we should explore. You've started to see some strong dynamics in New York and San Francisco, so improving rent growth there and multifamily. And then other areas where it's been quite healthy for a while. So rental seniors housing and healthcare, which is a big part of the portfolio. Rents are growing there north of 5%. In retail, similar dynamics. And so very much by sector, and that's part of our job is to pick those sectors where you do have those favorable fundamentals, you can capture some of that growth.
Yeah, okay. You mentioned some of these geographies, and I can imagine you've got an A-grade retail outlet or office. They're difficult to replace, right? So there's a shortage of supply. So give us a sense of where supply is at the moment, considering the amount of growth we're getting.
Yeah, so from a retail perspective, this has been one of the key things which has driven our thesis for high-quality retail property. In many markets, you really haven't had a lot of supply in the US since the GFC and many years in the UK, Europe, and Australia. So these high-quality malls, one, they're in catchments where it's very difficult to bring new supply. Two, the math is simply not there in many cases. And so these properties are taking market share. There's good tenant demand, and there's still very little, if any, retail supply on the horizon. And when you break it down to other sectors, rental, seniors housing, similar. So again, big position in the portfolio. Supply hasn't responded despite extraordinarily strong operating conditions for that property type. Similar in office, replacement costs are substantially above in-place values. So those sectors are really seeing very minimal new supply. At the other end, data centers, a lot of supply, different dynamic there, which we can dig into. And then industrial and residential multifamily, somewhere in the middle. Still some supply happening, but it's come down a lot from those COVID peaks.
Okay. So given you guys are active managers and you select to particular sectors and geographies that you want to invest in, it doesn't sound like this is a all-in kind of opportunity where supply shortage, replacement costs and rental growth. So you really got to be selective on which sectors you're in. But your most favorable sectors, and we'll talk about which ones they are later, these dynamics that you're talking about of replacement costs and supply and rental growth, does this look like the tailwinds for the next 3 to 5 years, or are we looking that far ahead?
Yeah, that's right. When we look at the replacement costs for retail, for example, in the US, there's been a number of studies and REITs have published that you need rents anywhere from 30 to 40% higher to justify a lot of new retail real estate construction. For the rental seniors housing in North America, again, broadly, they're talking about 20+%, and then you'll first see supply at the luxury end. And then other segments, it depends depending on the markets that you're in. But broadly speaking, you need to see material rental growth until construction will come back. I think rental seniors housing is a great example of that, where it's very clear the fundamentals are very strong. Occupancy is growing, rates are growing, cash flow is growing substantially, but supply hasn't responded. And that's just because the math doesn't work yet. And it will over time. But as you alluded to in your question, we think we've got a good multi-year horizon of rental growth until supply starts to respond. I think the other thing which we haven't spoken about is just broadly the demand for capital at the moment, not just for real estate, but when you look at infrastructure, you look at what's going on in AI and tech, just the demand for capital broadly is significant. And obviously that's a challenge for real estate as well. It's positive in terms of lower supply, but just means there's less capital targeted at the sector than there has been historically.
Okay. I'm going to go back to a couple of comments you made around that last question you answered. I just can't understand that US retail needs to see uplift of rent by 30 to 40% to bring new supply on. Isn't that the home of e-commerce? Surely e-commerce has killed retail malls.
Yeah, that's a good question. And the UK is in a similar situation there, where they went through a pretty difficult period from that sort of 2017 through to 2019. And then COVID was a real challenge in both those markets. And values fell a lot, rents repriced. But through that experience, the appreciation of the tenants and the customer, the value of that physical storefront, that physical experience. From a retailer's perspective, it's their brand, it's lower customer acquisition costs, and it supports their e-commerce business. If you can get someone to buy online and come into store, you can make more sales, the returns. And so it really is a key part of an omni-channel retailer's distribution. And so when we look at the retail that we're investing in, it typically is the top quartile in terms of quality. Think of Scentre Group's malls here in Australia. You think about Unibail-Rodamco in Europe, those really top quality properties. They're taking market share, tenant demand is strong, rents are growing. And whilst there are some puts and takes in the consumer environment, broadly speaking, the spending for these malls is continuing to be very strong. So again, constructive outlook for that high quality retail real estate.
Okay. And then you also spoke about aged or resi. So there's a massive shortage. As we get older, I'm assuming we're going to need new supply. So what's that dynamic looking like at the moment?
Yeah, so where we invest in rental seniors housing, it's North America, Canada, and the UK. And there's a couple of features which make it attractive for investors. One, it's private pay, so there's no government funding, and it's a clean, simple rental model. So your mum or dad would move in and just pay rent for the period they're in the building and for their care needs. So simple cash flow, which is the first and foremost. And the reason there hasn't been a lot of supply is because the rents just haven't kept pace with the construction costs. And prior to COVID, there was some excess supply, particularly in North America. So the way that these cycles ordinarily work in real estate cycles is you'll go through a period of underbuild or a lack of construction. Rents will continue to grow until development becomes economic, and then you'll go through a development cycle. And these typically take a multi-year period. And so we would expect to see continued quite healthy rent growth over the next few years. And then gradually you'll start to see development come on in the luxury end and more to come. But really, when you look at the demographics, the volume of supply needed is quite significant. And in the US, for example, the industry's never really developed the volume of supply that is going to be needed over the coming years. So it's going to be interesting to see how the industry reorients And it will. When there's profits there to be made, it will. But from a landlord's perspective, we think we've got a pretty good runway for rent growth over the next few years and value growth.
So most of this that you're talking about, obviously replacement costs, that's probably can't keep up with the rate of inflation, the demand for aged and lifestyle assets in the US. So no doubt that'll be inflationary. How does the fund maintain the inflationary pressures to protect investors' capital?
Yeah, so the best way that real estate can offer some inflation protection, and it has through time under certain conditions. Clearly, when inflation is 4, 5, 6% and higher, as it was during COVID, that's difficult for many asset classes to protect against. But when you're in that more moderate 2 to 4, 2 to 4.5 type range, rental growth can be sufficient to provide that inflation protection, as in your cash flows are growing faster than inflation. And particularly when we've got discount rates at this level, when you're adjusting from 0 to 5, that's obviously a little bit more challenging. But given the sector has adjusted to the current interest rate environment, we've got low supply, rental growth is healthy and picking up in certain sectors. That growth in cash flow at inflation plus is what provides that inflation protection for investors.
Got it. And so when listeners need to understand your investment strategy, is there a pyramid the way you think about how to invest in certain sectors, geographies, asset classes? How do you break that down?
Yeah, so the way that we invest is very much bottom up, looking at property sector fundamentals. So we're not a regional investor. We don't say we want to overweight the US, underweight Europe, etc. It's where can we find the best relative value in different property types around the world. And often that can mean you'll have a sectoral dynamic which underpins a multi-year period of returns. So if you think back, we had logistics from 2017 through to 2022. Now, coming through COVID, we've got fantastic returns in healthcare real estate, and you've got aging demographics. So some of these sectoral dynamics can underpin real estate for a multi-year period. And we're looking at where we can find landlords that have pricing power and the ability to drive rents and cash flows at inflation plus type returns. And so we're allocating by property sectors. And so when you look at the portfolio construction, you'll see big overweights in those sectors where landlords have demonstrable pricing power, which means they can grow rents, they can grow cash flow, supports the dividend yield for investors and supports the growth in dividends and value over that period. So sectoral fundamentals, landlord pricing power. We look for vehicles with low leverage. So the portfolio has a loan to value of about 30%. And that for us minimizes the risk of permanent capital impairment for clients. So trying to provide some insulation from downside, which is inevitable in a cyclical sector like real estate.
Yeah, and comparing that loan to value ratio back to the GF, what did that look like at the time?
Yeah, so depending on the market, it was into the 40s for many.
Yeah.
And also back then, there was more development in the sector. Certain markets such as Australia had cross-currency hedges and all sorts of things going on. So the sector is far cleaner from a cash flow perspective, lower leverage. And again, for investors, this is predominantly investment grade. So these REITs are investment grade credits. And so that's a different profile to what you get in many syndicate unlisted type funds where leverage is often in the 40 to 55% range, non-investment grade and concentrated asset risk. So diversified, investment grade, lower leverage, cleaner cash flows, less development than there was during those times.
So putting all that together, are we in a sweet spot at the moment for global REITs where economic growth is relatively stable, say 1 to 3%, depending on the geography you're talking about? We've got this undersupply, replacement costs above current valuations. We've got inflation growth, which is pushing up rents, as we discussed. Is this a sweet spot where we could have a multi-year of benefit from investing in REITs?
Yeah, we think the setup is pretty constructive for the sector. After having rebased through the last 2 years, the supply outlook is favourable. Replacement costs are providing an impediment to supply. We think the REIT valuations on an absolute and particularly a relative basis are attractive, given that fundamental setup with high replacement costs and moderating supply. And so provided we continue to have a relatively healthy economy and we don't have material inflation or those sort of macro risks, the fundamentals are there for the sector, we think, to continue to provide competitive returns and some diversification for clients.
Okay. So now let's break down the sectors within REITs to get a better understanding of where you see the bigger opportunity. You spoke earlier about retail and US housing or the aged and lifestyle retirement compared to things like office or data centers or self-storage and the like. So how do you look at those and say where you want to be overweight and underweight?
Yes. I give a snapshot of the portfolio housing and healthcare real estate. 18% in high quality retail. So that's malls, grocery anchored shopping centers, North America, Europe, and Australia. There's 13% in rental apartments and houses and manufactured housing. So different to what Australia is in terms of the rental dynamic. These are sort of 6% initial yields. 13% in data centers, 11% in industrial, 6% in self-storage, 6% in office, and then there's 12% in diversified. So it is quite a diversified pool of real estate. And the way that we select where we want more exposure than less comes back to those fundamentals. So where do landlords have pricing power? Is the supply outlook favorable? Are you seeing positive market rent dynamics? Are you seeing improving tenant demand? And obviously overlaying valuation and valuation risks. And so underwriting the supply cycle is critical for us across those different sectors. So in terms of where we position at the moment, rental, seniors housing and healthcare real estate, again, supply hasn't responded, very constructive outlook and clear demographic driven demand in the years ahead. Data centers are still a reasonable overweight for the portfolio. It's probably a more in-depth conversation we can have there, but still very much a landlord's market. When you listen to the key customers, the hyperscalers, they're in a shortage of compute. And so we've got a reasonable exposure, we think, without overcommitting the portfolio to that thematic, given some of the dynamics there. Overweight residential, so that's something that's more recent in the portfolio, and we can expand on that. And where we've got less exposure is industrial logistics in North America, which is principally valuation. We're finding better opportunities elsewhere. Hotel gaming REITs, and we're still underweight some of the office and diversified segments in certain parts of the world.
Got it. All right. Let's go back to the data center and residential. Firstly, on data center. Now, there's obviously a lot of hype around the AI theme that would make most investors a little bit nervous that you remain confident. Why? And what gives you the confidence to remain slightly overweight that space?
Yeah, so we understand that the nervousness out there in terms of some of the AI dynamics, clearly quite an unpredictable space over the years ahead. The way that we've invested in data centers is, for some background for clients, we've been investing in Equinix particularly for the better part of 10 years and a number of other data center REITs which were privatized in recent years. So this is not necessarily a new thing for us, but the opportunity to clearly change substantially in the last few years. The business, which is the largest part of the portfolio, which is Equinix, which is about 7% of the portfolio, this is a retail co-location business. So what does that mean? Typically means you'll have numerous customers in a single facility down to a single rack versus the other end of the spectrum, which is hyperscale, where Google, Meta, Microsoft will lease the whole facility. We can have up to 100 customers in a single facility, and they're attracted to it because they've got their networks there, cloud providers, software as a service providers, and they sometimes physically cross-connect cables between their servers to increase the security and reduce the latency there. So it's a very defendable, less replicable form of data center. And it's also one that's not seeing anywhere near the volume of supply at the moment. You do need an operating business behind it. The hyperscale end is where you're seeing the vast majority of the development. And that's where you see all the headlines, these 10, 20, 30, $40 billion facilities. To us, the risk there is some of these tier 2, tier 3 locations where the residual value or the use case may be less fungible. And so for us, investing in the two leading listed global players, they're investing in predominantly in their core markets. The use cases are fungible. So if AI doesn't work, you can use it for cloud and you can use it for enterprise. So we think that provides some insulation. It doesn't mean you're immune if there's a broader AI collapse, but we're concentrated in the best capitalized leading players in core markets. We think provides a defendable exposure in a market where pricing is still accelerating, supply is still constrained, supply constraints getting worse, and the key customers are highlighting that their businesses are being constrained by a lack of compute.
Understood. We're recording on the 5th of August. Interestingly, overnight Caterpillar reported their numbers, and they are heavily exposed to the build out of AI and data centers, and they upgraded their earnings per share growth from low double digits, so say 11 to say 12%, to mid-teens, so 14 to 16% growth. It just highlights the build out that is still going on, data centers in the US especially. So, yep, okay. So then you spoke about residential. Now, Interestingly, there's a lot of headlines in Australia about residential. Tell us the different dynamics between the geographies of here in the US and why residentials look so attractive.
Yeah, so residential for us in the US is purpose-built rental apartments and single-family homes. Again, these are all big public companies, 20, 30 billion EVs. It's a different market over there where it is a true cash flow investment. So at the moment, we're investing in these rental apartments at a 6% net cash yield, and they're growing rents on the coasts at around 2 to 3%. So it's more a cash flow driven investment versus Australia, which has been historically more capital driven with lower yields. In parts of the US around the Sun Belt, so I think Texas, Arizona, Carolinas, Florida, they saw significant supply through COVID and in recent years. And as a result, we haven't been invested in those markets, and the tail end of that is now working through the system. But on the coasts, you had pricing power starting to improve in those markets, so they've digested some supply. And the jobs market in the US has been patchy, but still reasonably constructive. And so we think reasonable valuations for this sector, indications that pricing power is gradually improving in a well-capitalized, well-run, defendable cash flow business. Also, to the extent which you do have inflation, these are short lease properties and can pass through that inflation relatively well. So we think a sector which has been lagging a little bit, is discounted, supply is burning off, offers reasonable prospects for growth in the years ahead.
Fantastic. Okay, so for investors that want to do some more work on the fund and to get a better understanding, the portfolio itself, the diversified portfolio, what kind of income should it generate over the next 12 and 24 months?
Yeah, so for REITs globally, it is in the 3 to 3.5% range. So it's not an income product per se, but significantly higher than what you'll get for global equities, obviously. The return profile is really driven also by the earnings growth, which we're expecting in that 6 to 7% range over the next 3 years. High single digit, 10% total return for the portfolio without any change in multiple, obviously. We think it's a reasonable base given where multiples are slightly above longer term averages and at a significant discount to the broader equity market. And again, more importantly for us as real estate investors, pretty undemanding versus replacement cost, that true intrinsic value. So that's the return profile. Again, for a listed investment can swing around 18% in the last 12 months, but that's the fundamental way to think through the building blocks.
Obviously, the general advice disclaimer, Julian, anything we discuss today is general advice only. Anyone acting on that advice without written and agreed consent does so entirely at their own risk. And obviously the 18% performance is past performance and it's not an indicator of future performance.
Correct.
But let me ask you this, Julian, when, if ever, has a global REIT fund or the total cash flow been able to grow by 6 to 7% a year?
Yeah, it's a good question. So it's been a number of years since we've clearly seen that level of growth. And it's some of those segments such as healthcare, data centers, where you are seeing really strong earnings growth and rental growth out of them. But pleasingly for us, just coming through reporting season now, we're starting to see evidence that's broadening to some of these sectors we touched on that have had supply, such as apartments, self-storage, etc. So you're seeing that broaden as well, which is encouraging. So to us, pretty constructive outlook. And yes, it's been a number of years since we've enjoyed that sort of earnings growth outlook for the sector.
What are some of the risks in the outlook
Yeah.
for global REITs?
Yeah, so the big risks to us are macro. So demand falters, some sort of inflation shock that sees discount rates spike a lot higher. They're clearly the big risks. And then those are the big macro risks at the moment because the other one would be AI. And I say that we think our portfolio providing good diversification, but I do think the broader US economy is so tied in to AI at the moment. I think we would do better than many areas of the market, but yeah, that could be a recessionary type environment and we'd have to be repositioning as a result of that. But inflation rates and what happens with AI.
On the flip side of that, though, if there was going to be a recession because some sort of AI unwind, that would be great for rates.
Yep.
Which would ultimately support the global REIT sector.
That's right. And there's plenty of defensive opportunities we've got to rotate capital. And so that's what we would do in that sort of environment. Look, at the moment, US reporting season, as you alluded to, very strong. We're seeing it across retail. It's a pretty healthy environment, particularly in the US, a little bit spotty elsewhere, but.
Yep, I saw as well the European MSCI looks like it's growing its earnings about 14%, which is the fastest growth rate in the last 5 years.
Yeah.
So some big numbers. All right, Julian, thanks so much for your time and looking forward to our next conversation.
Rob, great to be here.